Hello and welcome to yet another episode of Asian Tigers. Today we'll talk about mid-caps and small caps. Yes, there are lots of fund managers who focus on that, and my guest today is a specialist on mid-caps and small-cap investing, Ayaz Motiwala of the Amala Emerging Asia Fund. Ayaz, very good to talk to you again. How has it been the last few months with mid-cap and small-cap valuations going through the roof? How have you approached it as a fund manager?
Good morning, Udayan, and thank you for having me. So it's it's been a rough ride to say to start our discussion, but there've been pockets of value, and one has made an attempt to go beyond as mentioned in the past, the conventional sort of visible high quality stocks. And made an attempt to try and ferret out some of these smaller or middle-sized companies, which make sense more from a medium-term perspective, looking out 18-24 months.
Is it possible to find companies which are growing at, say, 12-13% as opposed to the 7-8% that the industry has ground down to the larger companies? I mean, I know that you own a stock called LT Infotech. What is the kind of thinking that's going on? I mean, are you just playing bombed out valuations in the sector, or do you think LT Infotech presents a slightly higher growth paradigm than some of the larger IT names?
Yeah, that's a very good question, and we indeed own this stock. So the premise earlier has been that mid-cap IT per se, and and rightly proven, has really not stacked up against what the 4 or 5 large cap peers have done in the past. And so essentially it's always been a little bit of this valuation game that you talk about, and we've seen that catch-up trade being played out between sort of 2013 and 15 for players which have made it, such as say a Mindtree, which comes immediately at the top of the head. Now here we are at a crossroad of an opportunity, and there is this company which has largely through an organic fashion over the last 15-20 years, part of a division of L&T and then moved on, has become close to $1 billion revenue run rate company. It is on the cusp of change because the industry is changing indeed, and we see digital transformation projects being a large constituent of the new sort of RFPs, RFQs which are going on in the industry. So for this to actually make an investment case on a medium-term basis, it actually has to deliver plain old earnings growth with the profitability being maintained and intact. So the investment case is back to saying that this company is in a relative sense more nimble and smarter, is going to get incremental market share more than what it exists in its base, and thus grow in this sort of 12 to 15% kind of range to be able to attract incremental investors beyond what we've owned up, because these investors are currently naysayers who are not excited by the prospects of IT in general, and in some sense they're saying show me the growth. So these companies, the way out is indeed going to be able to participate and capture incremental growth in the industry, and thus make worthy sense.
What is true of IT, is it also true in your book of pharmaceuticals? And are you able to spot opportunities in mid-cap pharmaceuticals given the mayhem which is going on? I mean, some bad news comes in, a Divi's or a Lupin or a Sun, and stocks tank 20-25%. Are you brave enough to wade through there and try and pick out one mid-cap pharma which can actually deliver the goods?
Right. So as we've sort of spoken in the past, that it's become sort of newsy and very event driven, and in some sort of odd sense, the timing of the event is uncontrollable, where you suddenly get this 483 or whatever the announcement is called, and the stocks take a beating. This pharma as a field is a much more broad based, if you will appreciate, versus especially the past of the IT services business, where you have ADM and support services, package installation, etc. Much more sort of vanilla, more straight and simple businesses. You have the whole gamut of pharma companies in India, from an extreme of addressing domestic branded generics business to doing, CRO, and then you have a mix of all these international companies, the large pharma names, some of which you alluded to, such as the Lupin or Aurobindo, etc. So in our sort of our attempt right now is to try and see what is the downside, which we are always focused on, and basically see if the business is going to be affected by externalities such as an announcement on process or how the research is conducted, etc., which is completely an uncontrollable factor, both from our perspective in particular, but also from a company's perspective for the way they've operated over the last 15, 20 years. So, so to put a sort of concrete wrapper around what we are talking, we are essentially looking at more domestic opportunities, which in some sense are sort of the branded consumer generics pharmaceutical companies like FMCG product but the nature being basically pharma as such. And this was the nature of the multinational companies such as Glaxo, who operated in India in that capacity. So we are going back to that kind of aspect of the business. There is Aventis, etc., where we feel that there could be a relative opportunity to this, para 4 challengers, the generic growth opportunity, complex generics is what people talk about, etc. So our understanding of that is currently limited. We're indeed working on that, but what we are more focused on in the near term is the domestic opportunity.
Sure. But sticking with exporters, I know you track chemicals. We've spoken in the past about some of the chemical stocks that you owned. What about names like Vinity Organics, which I think you did have in your fund? Because the recent numbers in many of these chemical exporters like SRF or Vinity have been a bit underwhelming, perhaps because the global specialty chemicals market is not firing yet. Should one be patient out here, or are you disappointed with the kind of progress you're seeing there?
Right. So we continue to own that stock, and our excitement has been the long-range delivery of this company, where I think revenues and profits have compounded upwards of 25%. And in the last 2 to 3 years, there's been one big aspect of their cost, and thus the revenue profile, which is linked to the crude oil prices, which came off from a $100 sort of handle to in the 40s and 50s. So the nominal revenue growth has been indeed affected by that aspect of the business for revenue growth to show up. The other is the nature of the business, which is where they are onto these new chemical entities or new molecules, if you call them, and then they sort of seed the market. There is a product acceptance, and then there is a ramp up which happens. So they have the existing business, which is delivering the kind of numbers that you talked about. And yes, indeed, in the very near term, on an expectation basis, the numbers could have been better, as we would ask as an investor. But then one shouldn't forget that the market gives the valuations. The company is sort of delivering its economic performance, and this is the same stock which is sort of in the 300-400 price range about 2 years ago, which is probably taken up 2.5 times, and thus the valuation is in the 25 and 30 times earnings, where the growth is pedestrian, so to speak, in the 10 to 12% range. So there is indeed a mismatch where market participants have gotten excited, taken it to a level which, in now looking back, is not justifying its delivery of earnings. And we talked about the entire aspect of why these earnings have a step-up function. So I guess it needs time, and we are going to give it time for what it has achieved over this sort of 2 decades of existence.
Sure. But tell me, as a fund manager, your job is not just to buy stocks, but also to sell stocks when they've gone up a lot and maybe ahead of earnings delivery. In the last 6 months or so since we spoke, Have you taken profits out of some of these mid-caps because of the kind of performance they have seen? Have you exited any stock completely? I mean, if you could illustrate with a couple of examples.
Sure. So one name we have owned, and I'm not sure if we have spoken on that name, but we've probably part exited, is a company called Siaram Silk Mills, which we owned for the entire sort of 2.5 years of this new fund. And there was a point in time, even as late as a little after demonetization last year, which is barely 12 months back, that this stock was close to a purchase price of about 950 or 1,000 rupees. The stock has had a 5-for-1 stock split now. So, so this stock from 200 is now at 500. And the entire magic has happened in the last sort of 9 to 10 months. So clearly, if you were to talk about Vinati just recently in the earlier question, these earnings aren't going to come in higher than 15 to 20%, where the stock has been re-rated massively, as you would appreciate, and has gone nearly 3x of our sort of purchase price. So we've taken money off the table on this name in particular. We also sold partly a small holding in again partly in Care Ratings, and an auto part company which we had talked about last time, Minda Corp. We've taken profits on those as well. So each of these names, essentially either the last 6 months or the year-to-date basis, have arguably gone up between 50 and 150%. And I don't think the valuations or the growth aspects or the story ahead justifies some of these names. So we're indeed taking hopefully a prudent view and taking some money off the table out here as well.